Good morning, everyone, and thanks for joining us today for the second quarter update of the Nedgroup Investments Global Cautious Fund. My name is Douglas Nicol, and I'm an investment analyst on the Best of Breed team here at Nedgroup Investments. And today I'm joined by Tony Cousins, who's the CEO and CIO of Pyrford International, who are based out of London and are the manager of the Nedgroup Investments Global Cautious Fund. Thanks for joining us today, Tony. A couple of items just to get through before we get started. For those of you who have dialed in through Teams, there is a Q&A function on the right-hand side of your screens. So please do feel free to ask questions, which I'll then pose to Tony at the end of his presentation. And if you have dialed in via your phone as anonymous, I would just urge you to please register your name in the Q&A so that you can get your CPD points. Just to provide you a little bit of context before I hand over to Tony, Pyrford is a very established investment manager, and they've been running a global multi-asset strategy since 1994. Pyrford's philosophy is grounded in a capital preservation mindset, and they have a very value-disciplined investment approach and a strong emphasis on implementing their process even when things get difficult. Which you can see in the way that they've managed their fund in 2008 and more recently during the recent coronavirus drawdown. And we feel this makes Pyrford the ideal investment manager of the Global Cautious Fund, which seeks to deliver a stable stream of real returns in excess of cash over 3 years. The manager looks to achieve this through a very low weighting to equity, but then a high allocation to fixed income products. And typically the type of customer or client that we're targeting is someone who's looking to take money offshore but doesn't want to take a lot of risk, but doesn't want to go into cash because of the low returns on offer there. So after strong relative performance in Q1, Tony's going to take us through the fund's second quarter's performance, as we've really seen a truly remarkable rebound in returns across asset classes. So Tony, over to you.
Thank you, Doug, and good morning to everybody, and thanks for your time today. Okay, moving on to quarter two. This is slide 3 we're going to be looking at here. This shows that we delivered 4.5% on the quarter and breaks this down into where that return comes from. Clearly, the big contribution was from equities, both US equities and non-US equities, and also non-US dollar bonds, which was the weakness in the US dollar. US bonds themselves yields having fallen sharply in the first quarter, effectively delivered nothing for the second quarter. We do see a negative here for cash and currency hedging. I will come on to explain that. We do run the non-US exposure, unhedged exposure, up to a maximum of 45%. So to the extent that we are owners of non-US assets in excess of 45%, we have to hedge back to stay within that risk parameter that we employ. So moving on to slide 4, just the comments on the performance. Obviously, we had a positive absolute return in a very strong market environment in Q2. I'll come on in a second to talk about our exposure to equities. We did increase that at the end of or in the middle of March, so the end of the first quarter, and increasing equities obviously benefit the fund because they're very strong in the second quarter. We have unhedged exposure around about 42%, so right at the top of our 0 to 45% range, as the US dollar was generally weaker following tremendous strength in the first quarter. That benefited the fund. Obviously, to the extent that we hedged to come back within that 45% risk parameter, that hedging was an opportunity lost, because we would have made more money if we hadn't hedged. And our equity portfolio, it did lag the US and the overseas markets. This is really a function of the value and quality characteristics of our equity portfolio. These are very high quality defensive stocks. They perform very well in very difficult market times, but they do tend to lag in very strong liquidity driven rallies, which is what we saw in the second quarter. So that's why they didn't quite keep pace with the market. Moving on to the next slide, we see really what the action during the quarter. As you'll all be aware, markets fell incredibly sharply from so the end of February through to the end of March, and we took that opportunity to increase the equity weighting from 25 to 30%. You remember, within this portfolio we are constrained, we cannot go above 40, so we used some of that firepower to increase equities. Very importantly, that was all put into non-US equities. We did feel that prior to the decline, US equities were an outlier in terms of overvaluation, and that persisted during the market decline. They remained significantly more expensive than non-US equities, so we took the decision that the additional 5% in equities would all go into non-US markets, and that's something we did on the 12th of March. Clearly we have seen a phenomenal rally in equities, and the EFI index, Europe, Australia and Far East, which is essentially the world excluding North America, that rose 22% between the 12th of March and the 4th of June. However, very importantly, the dividends paid on that index fell 27% during that time. So the yield on the market went from 4.4 to 2.64 over that time. That hit one of our trigger points, and we took the decision on the 4th of June to remove that 5% from the equity weighting, bringing it back down to 25%. The way we work here is we have preset trigger points based on what we call a value indicator. That's something as part of a key part of our process at Pyrford, which is our key assessment of value. It consists of the dividend yield on the market plus our long-term forecast of sustainable growth in earnings and dividends per share. So that is the key criterion that we use for all our equity decisions actually in Pyrford, what the equity weighting should be, which countries it should be in, and which stocks. So that is a common thread that runs through our equity process. So what we have seen now is equity markets that we believe have returned to quite heady levels. The next slide is a key indicator we use. This is the cyclically adjusted price earnings ratio of the US equity market. Now, this is published quarterly. The end June figure has not yet been published, so it looks like it's come down an awful lot. When that number is published, it will have gone up very significantly from the previous level at the end of March. At that point, it will be significantly higher than it was at the top of the 2008 market peak. I mean, look at other measures. The prospective price earnings ratio for the US equity market will be back to a 20-year high. So markets are clearly discounting an incredibly strong recovery in earnings in the US. And we think that that is overly optimistic, and that's why we've taken a more cautious view on equities. Moving on to the dollar. The dollar was obviously very strong in the first quarter. That's typical during times of market panic. Investors rush to the reserve currency of the world, and that's precisely what happened. To a degree, that was reversed in the second quarter. not against sterling, but against Canadian dollar, Aussie dollar, Swiss franc, three currencies we put up here. The US dollar was weaker against the Canadian dollar, Aussie dollar, sterling. It's still up for the year, but clearly gave some of that return back in the second quarter. Slide 8 looks at the key tool we use for measuring currency valuation. This is called purchasing power parity. For those who are interested in technicalities, it's the regression analysis of wholesale pricing differentials. I should imagine most of you are not interested in that, but what this is effectively a measure of export competitiveness. If a currency remains significantly overvalued on this measure for a good amount of time, its exports will be priced out of the market, its trade account and current account will deteriorate, and that tends to lead to currency weakness in the end to correct that position. What you can see here, since currencies floated in the early 70s, is the blue line is the measure of fair value that we calculate internally. The green line is the spot rate. We produce these charts for every single currency pair we can be exposed to, and as you can see, the green line always comes back to the blue line. The shading is 25%, which is equivalent to 2 standard deviations either side of the line of fair value, and what this shows is that the US dollar is an extremely expensive currency. It is about, against sterling, about 25% overvalued against the pound. So this is and this is mirrored in the other currencies that we have left unhedged in the portfolio. So this is why we are at the top end of our 0 to 45% risk parameter within this portfolio, because we would expect the US dollar to weaken. That started to happen in the second quarter, and we do believe over time the US dollar will continue to weaken. So on slide 9, we show the exposure of the portfolio to various asset classes and the various countries. We remain very conservative with 72% in bonds. The duration of these bonds is very, very low. It's you see on the right hand side there, modified duration of 1 year. Our view on fixed income is that long duration bonds, which are very, very volatile, are effectively return free risk. The yield that you get on these is minimal, but the risk you are taking is enormous. As an example, if you were to own a US 30-year bond today, you would be buying a duration of about 27, 28 years. What that means is that if the yield on those bonds rises by just 1%, then you would lose a little over 25% of your money, which is obviously a fairly catastrophic outcome. If you continue to own those bonds, of course the yield could fall a little bit further, but what you're looking at is a very asymmetric risk profile. You could pick up a little bit higher yield than at the short end, but you are risking significant capital loss should those yields rise. And our analysis indicates that the yields on high quality sovereign bonds are exceptionally low in real terms, between -1% -2%, and that is against history a very, very poor entry point into longer duration bonds. So the bonds that we own for you cannot make a lot of money because they're so short duration, but they also cannot lose it either. So this is a form of capital preservation. You'll see most of the bonds, or the majority of the bonds, are outside the US dollar, and that reflects the currency positioning that we have, which I talked about earlier. I put market outlook slides here up. There's two of them, slides 10 and slides 11. What we have seen since the onset of this crisis is an absolutely unprecedented level of government and central bank support, highly coordinated, and this was absolutely necessary. The world has not seen a demand shock like this in the pandemic before, and what was required was the fiscal and monetary stimulus to build a bridge between the pre-COVID world and hopefully the post-COVID world. The problem here is the longer that period goes on, the more rickety the bridge becomes. It isn't a bottomless pit of money. We have seen vast fiscal programs to pay wages, to support consumption in many different forms in different countries, but these are now coming to the end. Unless they are renewed at the end of this month, the $600 a week that US workers get who have been laid off in terms of unemployment assistance, this will come to an end. In the UK, for example, the furlough scheme, which pays 80% of wages for employees who can no longer work because of COVID-19, that has been extended, but employers are going to be required to pick up more and more of the burden, so less of it falls on government, and that is likely to concentrate the mind of the employers. Do they really want to pay this, or would they rather just lay the workers off? We think that there will be very significant further rises in effectively permanent unemployment, and this obviously has a knock-on effect to the economy. So we are not in the camp that says it will be a very sharp V-shaped recovery. We think this is far more prolonged, that there has been a huge amount of wealth destruction. There has been a huge amount of debt build-up, both in the public and the private sector, and that the workout from this is going to be very long and very hard. I mean, I didn't come on here this morning to depress you, but I think just as realists, we have to say that this is an unprecedented demand shock, and that the recovery from it is not going to be a breeze, which is what markets seem to be expecting. Valuations of equities, as I mentioned, have risen very sharply, and we do believe that they are well ahead of ourselves. So we took the decision to step back and reduce the risk of the portfolio in line with the cautious mandate that we have. So I'll just finish off here with the portfolio, which is on slide 12. Here you'll see, as I discussed, our exposure is only to the highest quality bond markets: US, Canada, Australia, the UK. The duration is very low. Equity exposure back down to 25%, and you'll see there is a significant favoritism here for the markets of Asia, certainly relative to their own size. We do believe that Asia is going to recover better than the rest of the world. They have seen far more aggressive lockdowns. They've seen less economic damage from COVID-19, and they are seeing stronger recoveries. Now, our preference for Asia is something that we've talked about for a long time now. Asia just has, this is Asia excluding Japan, significantly greater growth potential than the other developed markets within the world. It has better demographics, it has lower debt penetration, It has higher savings ratios. It has stronger productivity growth from a lower base, and those all combined will lead to outperformance in terms of economic growth. The markets also offer better valuations, and that whole mix there makes us more comfortable having a significant position within the Asian markets. Just looking at Europe for a second, you will notice that our exposure to continental Europe is entirely in sort of central to northern Europe, Scandinavia, Switzerland, Germany, a little bit in France. We have no exposure at all to peripheral southern Europe. This is an area which is in a lot of trouble. Italy, which is, let's face it, it's a G7 country, the third largest bond market in the world, has taken a massive hit from this crisis. It was already in trouble before COVID-19 came along. It's in a lot more trouble now. The decline in GDP means that Italy has seen zero cumulative growth in its economy in real terms for 20 years. This has led to a lot of economic problems, very high unemployment, and a very sickly banking system as well. So this is something we remain very concerned about, and we are not going to risk our clients' money in peripheral southern Europe, given those fundamentals. Okay, I think those are my sort of lead-off remarks. I think this works better now if we move on to questions to concentrate on the issues that you folks would like to speak about. So thanks very much for listening, and very happy now to answer any questions that you've got.
Thanks, Tony. And I would like to take this opportunity to remind everyone just to look at the right-hand side of the screens, and there should be a Q&A which they can use to post questions. Tony, I think an interesting point to start off with would be to talk around the equity rating. I guess the obvious question is, why did you only increase from 25 to 30%? And maybe before you get into it, I remember looking, I don't know if this was coincidental or not, but when I looked through your philosophy documents at this, when we were looking, or when we were reviewing the Pyrford proposition, you made a very interesting point around why you are so focused on capital preservation. And that was because you stated that if markets fell by 30%, which the ACWI did recently, for an investor to recover their absolute levels of wealth, they would have to have the market recover by 44%. And I think that's quite a crucial concept in terms of how we structure the weighting on this portfolio. But I'll let you comment further.
Sure. Yeah. Well, I think those figures are that it's mathematics, isn't it? If you make 30% and lose 30%, or lose 30% and make 30%, you're down 9% at the end of that equation. So capital preservation in terms of generating long-term wealth is clearly very, very important. Rule number one at Pyrford is don't lose the money, because you have to work so much harder to make it back once you've done that. The other thing you do need to do, though, is when the facts change, you need to change your point of view. We take I guess as the fund says, a cautious, conservative approach to that. Now, as markets were collapsing in the middle of March, what we don't try and do is guess the bottom and put it all on red or all on black, like you would do playing roulette. The essence of this strategy is, as an asset class gets cheaper, we will lean into it. Now, on March the 12th, when we bought overseas equities, non-US equities from this portfolio, the yield on those equities was 4.4%, coupled with our forecast of earnings growth. That gave a real earnings growth. That gave what we call a value indicator of just slightly under 6. Now that's really equivalent of fair value. It isn't saying that markets are super cheap, so that's why we didn't go up to the maximum here of 40%. What you don't try and do in portfolio management is catch a falling knife and then put all your firepower into that asset class on a particular day. If markets had continued to fall further, we would have bought more up to that maximum that were permitted in the strategy, and we reflected that in our other strategies in the Aussie dollar and the sterling version of this fund as well. So since that point, obviously equity markets have rallied, but let's not lose sight of the fact that a lot of dividends have been cut. We've seen dividend cuts in excess of 20%. Now, some of these are because of economic damage. Some of these, like the banking sector, are because of real regulatory and political pressure. Elsewhere, particularly in Europe, governments don't want companies to take income, financial support from the governments and pay it straight out to shareholders in the forms of dividends. So there has been immense pressure to cut those dividends, and that, a combination of the market rally and the cuts in dividends, have taken that value indicator down. The yield on the overseas equity portfolio, or the overseas equity index, fell to 2.6%, as I mentioned. So at that point, it is once again overvalued on our key criterion, which is why we reduced the position.
And Tony, reflecting on some of the facts that have changed, we have seen an extraordinary amount of QE being pumped into the system. This has obviously led to rates in the US, which are almost in real terms at zero or below zero. How is that being reflected, or is that being reflected in some of the models that you are building for your value indicators?
Well, I think we've been living in an era of financial repression for a long time now, with central banks, driving down interest rates, pumping money into the system. I think that this has just got a bit more aggressive now, and you're actually seeing coordinated fiscal and monetary measures. This was necessary. Markets were in panic. The fiscal measures were necessary to support income and consumption, and central banks could not allow a bond auction to fail. So they had to be there to support government yields, to support all sorts of credit markets, and that's what happened. So I don't think that this is going to go away anytime soon, but there's obviously a limit. If these fiscal programs are not refreshed, the effect of them will drop away, and as I mentioned, more people will be laid off. They will cease to get government assistance, and they will necessarily not have the money to spend on consumption, and that's why we believe the economy is going to be, that the economic recovery is going to be quite prolonged and pretty subdued. I think there will be further fiscal stimulus, and those bonds will be bought by central banks, so there will be continued. But there's a lot of politics at play here. In the US, Trump is in favor of ending the unemployment benefits, because he thinks that they are a disincentive for people going back to work, and that's a very orthodox Republican stance. The Democrats want them to be extended. So there is something of a political impasse here, and let's not forget we have an election coming up in November. So I do think these conditions are are here to stay, but I don't think at the moment that they're sufficient to generate the V-shaped recovery that markets appear to be discounting.
And given some of the tensions, we have a great question here around some of the tensions that are starting to brew between China, the US, and Europe to some extent as well. Is this likely going to feed into a more volatile equity market? What are your views on that?
Well, I think we've had a trade war going on for some time. This is now morphing into something of a capital war, with Trump putting pressure on US funds, even passive funds, not to own Chinese assets. There were moves to delist Chinese companies from American exchanges. This is an unwanted, in my view, and poor development, but it is driven by the politics, the growing Cold War between China and the US. The extent to which this persists, I think, is very much dependent on what happens in November. If Trump gets re-elected, and that's looking less likely, much less likely than it was, this is his MO, and he doesn't need to get elected again. So he's, you may think some of his behaviour has been rather reckless already, but once he's won the second term, he's really off the leash. So there is quite the possibility for this to deteriorate further, and markets will not like that. Should Biden win the election, then I think you'll see an easing back of this. But it's clearly, protectionism is a bad thing. It does suppress growth. And then if we see effective capital constraints, that's not a good thing either. So this does depend on the politics.
Thanks, Tony. We've got a very interesting question here, which I think would be, as a valuation-driven investor, would be good to hear your opinion. And there's a lot of headlines that are saying value investing is dead. And after growth that has had such a remarkable run, what are your views on this element of the market?
Okay, well, as a short value investor and looking at sort of many decades of history, I'm obviously not going to agree with that. We've seen bubbles like this in the past. I've been doing this for over 30 years. This bubble that we saw in the up to the end of 2019 actually wasn't the worst. We saw this in 1999. Some of our older listeners will remember stocks being valued on price per click and all that sort of nonsense that was going on back then. Bubbles do occur in equity markets, and when they burst, it's very painful. Prior to us going live today, we were talking about Tesla. The market value of Tesla is the same as the size of the Federal Reserve balance sheet, which is absolutely extraordinary. And the leadership of the US market has become narrower and narrower, very much concentrated in these new economy tech stocks, and we do see this as quite concerning because the valuations on these are quite sort of extraordinary. I just cannot bring myself to consider buying Netflix on 96.5 times earnings, is where it closed last night. I think what you get from equity markets in the long term is the income you buy in the form of dividend and the subsequent growth in that income. That sort of comes out to about 5.5 to 6% in real terms, and that's what you get paid for the risk of investing in them. If you buy equities when you are not getting that level, that 5.5 to 6%, which you are not today, and you weren't at the end of 2019, and you never have at the top of bubbles, then your subsequent returns have always proved to be very disappointing. And that's where we are right now. And we don't think that a short-term bubble in FANG stocks trumps 100 years of history of stock markets and the fundamentals that drive them. So no, we remain value investors.
And I think that argument is quite interesting, because when you actually look at the composition of the Russell 1000 index value, it's 41% of that of by sector is actually financials, whereas the value or the growth Russell growth index is about 41% technology. So I think it's more a discussion on do you believe in investing in financials versus technology at this point. And I think oftentimes that there's a subtle nuance to that argument that's maybe neglected.
Yeah, I think just on that point, Doug, I mean, I think value has been very disappointing because financials have been very disappointing, particularly banks and overwhelmingly European banks. And this has been a value trap. I think that one of the keys here is how you measure value. Now, banks have looked incredibly cheap on price to book value, price to tangible asset value. And that is because the book value number, unfortunately, is a great work of fiction. It's arrived at by using a bunch of accounting tricks and lax regulation and all sorts of esoteric rules to pretend that these banks are stronger than they are. Now, we've looked into this in a lot of detail, and we haven't owned a European bank for a decade now. This has proved to be a horrible value trap. And what has enabled us to avoid it is our measure of value is dividend yield plus sustainable growth. And we've looked at these banks and said that there is no sustainable growth, even if they are paying a dividend, and many of them are not. And coming back to your question about very low interest rates, and in some jurisdictions, negative interest rates, this is an awful environment for banks because their net interest margin, which is how they make the money between deposits and assets, gets crushed. And that is precisely what has happened. And so I think, you are right, value indices are dominated by financials, but I don't want to put our listeners at ease that we are not exposed to banking in this portfolio. The only the only bank we own is UOB in Singapore.
Great. Tony, one last question before we finish up. The fund or your strategy in the past has invested in global property. This asset class has come back quite a bit this year, and has been one of the poorer performing sectors in global markets. Is it starting to become more attractive to you, or are you waiting for signs of recovery to come through?
Well, there's a number of things. Clearly, if it's got cheaper, it is more attractive. I think what we're seeing here is commercial office property in particular is under pressure. Retail property has been under pressure with the move to online and declining footfall on the high street and in shopping malls for some time. One of the effects of the coronavirus crisis is obviously people working from home, and that has led major corporations to question how much commercial property they actually need. And I can talk from it's a published figure for our parent organisation. They are looking over the next 10 years to cut property costs by 50%. By just moving to a different way of working, people working more from home, because they've been very impressed with the experience of it, and it hasn't led to a decline in productivity. So I think we need to see how this plays out. Clearly, the prices of property have come down, but the demand for it is quite questionable at the moment. And in the end, a property is worth the income it produces, and an empty property produces zero income. So that's the outlook we need to see play out, and just what the demand for commercial real estate is going forward.
Great. I believe that's all the time we have left for Q&A today. And I thank you again, Tony, for taking your time away from the desk to facilitate this call. And I really do hope that this conversation was both useful and informative for those who are listening on the call. For those of you who do have further questions on the Nedgroup Investments Global Cautious Fund, please do contact your relationship manager, and we'd be more than happy to assist with any queries you may have on the fund. I would like to flag your attention for our next call this afternoon, which will be with Ardevra, who manage the Global Diversified Equity Fund, and that will take place at 4 o'clock this afternoon. But for now, from myself, Tony, and my colleagues in Nedgroup Investments, good day, or goodbye, take care, and enjoy the rest of your day. Thank you very much. Bye-bye.
Thank you. Bye-bye.